if you're buying $70 silver, $71 silver, you're not buying the top. The top was 84. We've had a significant correction in the silver market, and it's still above 70. 50 is gone. The opportunity to buy $50 silver doesn't exist anymore. Once we went through 50, we were going to make a quick move up to 100. And my forecast was $100 silver by next year. And we're certainly on track to get there. I don't think the action over the past week looks anything like what we saw in 1980 or 2011. Silver had a big spike and now it's dropped. And so this is the end of the bull market. So silver went up more than 10x before it had that big surge. Buy the breakout in silver. I don't think gold's going back below 4,000. I mean, I think maybe 4,200 could be the support in gold, but I think that we're not going to see gold below 4,000. I think we're going to see it above 5,000. We may even get to 6,000. Silver, the star performer of the year, up just over 140%. Silver closed around $71 an ounce. Last I looked at it, that's about where it was. I'll double check it again. It's been very volatile. In fact, silver got clobbered today. It was down over $5, I think, today for silver. Gold only down about $20, so about 0.5%. Silver down $4.60. So it closed over 71.50. So it snapped back a little bit in the last hour or so of trade, down 6% on the day. But closing the year above 71.5, I think that probably means that the year-to-date gain was above 140% for silver. The high that silver hit this year was Sunday night. That was just after, well, it had a big rally on Friday, the day after Christmas, Boxing Day. That's when silver soared, closing above $79 on Friday last week. And then on Sunday night, it almost traded as high as $84. Got to 83, above 83.50 before it had a violent correction. Part of that was, I think, caused by the futures exchanges. I think twice they raised the margin requirements on silver because of these outside, swings that were, not normal to see silver moving by so much in just a trading day.
The real story here isn't silver's 140% headline gain. It's how fragile that move became once leverage was forced out. A $5 single-day drop on a $70 asset signals speculative pressure, not calm accumulation. CME margin hikes have historically triggered sharp shakeouts, like in 2011, flushing weak hands without changing the underlying trend. As Peter Schiff often notes, volatility in metals usually rises before major upside continuation, not after peaks. Long-term investors should recognize this wasn't panic selling, it was mechanical de-risking. What matters next is whether physical demand absorbs futures-driven volatility. Next, Peter Schiff explains why this correction may have strengthened the trend, not ended it.
But, if you throw all that out and look at where silver ended up, it closed the year, again, above $70. Silver is still several dollars higher than it was when I did my last podcast before I left Puerto Rico for Christmas. But I did record a X space on Boxing Day, on that Friday, when silver closed above 79. And we had a big rise too, record high in platinum. Palladium was up like 13 or 14%. I mean, it was a huge precious metals rally. In fact, it was a metals rally. Copper also rose to an all-time record high. So it was metals just going up. But the significance is the rally and the breakout. We are now, $20 above 50, right? That was the double top. We're now more than 40% above that. And I know a lot of people are now talking about a blow-off top. They're trying to say that this is it for silver. And in fact, silver stocks didn't really gain very much. In fact, they barely rose at all on Friday. Then they got killed on Monday. I was looking at the market yesterday, and silver was up 15% on the month. Now it's given up some of those gains today, but as of yesterday, when silver was up 15% on the month, silver stocks were not even up 2% on the month.
When multiple metals break out together, silver, platinum, palladium, copper, it usually reflects macro liquidity shifts, not a speculative fluke. Copper hitting all-time highs matters because it confirms industrial demand strength, something silver also benefits from. Yet the real tell is silver stocks lagging badly while spot prices surge, a classic early cycle signal. As Peter Schiff has pointed out, miners typically lag first, then explode later when capital reallocates. A 15% monthly silver move versus sub 2% miner gains shows disbelief, not euphoria. That disbelief often fuels the next leg higher once cash finally rotates. Next, Peter Schiff explains why skepticism itself may be the strongest bullish signal of all.
So silver stock investors have not been that enthusiastic about the recent rally, which to me is again bullish because we had this same situation happen with gold stocks and gold the whole way up, right? The gold stock investors were very skeptical of the gold rally. They kept expecting gold to collapse. Meanwhile, it just kept climbing that wall of worry. Well, most of the stories, the financial stories I've seen about silver are about, another blow off top, just like 1980, just like 2011. Silver had a big spike and now it's dropped. And so this is the end of the bull market. And again, I think this skepticism is very bullish for silver. I don't think the action over the past week looks anything like what we saw in 1980 or 2011. Now, if you go back to the 1980 blow off, that was a 50x move. Silver went from $1 an ounce to basically $50 an ounce in one decade. So that's 50 times. What's happened recently isn't even close to something like that. And of course, it ended with the Hunt brothers trying to corner the market and the Fed jacking interest rates up to 20%. The Fed is cutting interest rates right now, and there is no Hunt brothers trying to corner anything. So very different situation than what was going on in 1980. Plus, of course, in 1980, the dollar was bottoming out after losing 2/3 of its value.
Calling every sharp move a blow-off top is how investors miss structural trends. In 1980, silver rose roughly 5,000% amid collapsing dollar confidence and emergency Fed tightening, conditions that simply don't exist today. Rate cuts, not hikes, define the current cycle, and positioning data shows no concentrated cornering like the Hunt era. Peter Schiff has repeatedly emphasized that true blow-offs coincide with universal bullishness. Yet skepticism dominates this narrative. For portfolio builders, this suggests patience over panic. Historical context matters more than emotional comparisons. And next, Peter Schiff talks how the dollar comparison quietly undermines the entire crash narrative.
We had a major dollar bear market from 1970 to 1980 where the dollar got killed. That's not happening now. We're not at the end of a dollar bear market in 2025. We're at the beginning. And in fact, look what happened with the Chinese yuan. The dollar closed on the low of the year against the Chinese yuan or RMB just below 8-1. The dollar's off about 5% year to date against the Chinese yuan. But I think the market for the dollar looks much weaker for 2026. What we've seen in the last week doesn't look anything like 1980. So you can't go back and say, yeah, this is another blow off top, just like then. And now silver is going to be in a bear market for 20 years. It's not going to happen. Number one. Now, looking at a more recent example of silver having a big move up was 2011 when it almost got to 50. It didn't quite get there. It got up to what, 47-ish, 48. But that rally also started in the year 2000, 1990. It was another 10-year move. Silver started around $4. So silver went up more than 10x before it had that big surge. Also, the significance of that surge was that it encountered resistance at $50. So it didn't break through the prior high. That's why it pulled back. But it also had a tenfold gain.
The dollar comparison quietly flips the narrative most headlines ignore. A 5% annual drop versus the yuan isn't collapse. It's early stage erosion, exactly when metals historically start repricing. Unlike 1980, this cycle begins before a full dollar breakdown, not after one. The 2011 comparison also misleads. Silver failed at $50 then, because resistance held, not because the trend was invalid. As Peter Schiff has noted, commodities often stall at prior highs before long consolidation phases reset positioning. Investors should see this as structural repricing, not terminal excess. Coming up next, Peter Schiff reframes silver's ceiling entirely.
Now, the most recent rally, if you really want to trace where the rally began, I think it began when silver broke above 30. And so the move from 30 to 80 was not even quite a triple. But more significant, the move didn't stop at the $50 resistance. It paused there, but then it blew through 50 and went all the way up to 84. That is a massive breakout. This is not a blow off top. This is a breakout of huge resistance that goes back to 1980. This is very significant technical action. The fact that we've pulled back to 70 doesn't negate the significance of the breakout above 50. And what I think is even better for people buying silver right now, because if you were looking at $70 silver a couple of weeks ago, people might have been afraid to buy the top. Oh, I don't want to buy 70 because it could go back down to 50. Well, now if you're buying $70 silver, $71 silver, you're not buying the top. The top was 84. We've had a significant correction in the silver market and it's still above 70. So the correction is already out of the way. It's not like there's a correction coming. It already came. And in fact, I think now the support for silver is around 70. It's not 50, it's 70, right? 50 is gone. The opportunity to buy $50 silver doesn't exist anymore.
The key detail most headlines gloss over is that silver didn't stall at resistance. It absorbed it. Breaking and holding above a level that capped price action for over 4 decades is rare, especially without broad retail mania. Technically, former resistance often becomes structural support, and that's exactly what $70 represents now. As technicians like Peter Schiff have long argued, failed pullbacks after major breakouts usually signal trend continuation. For investors, this reframes risk. The question isn't, is silver too high? But is the market repricing its long-term base? Next, Peter Schiff explains why conviction mattered long before this breakout ever showed up on charts.
And that is the reason that I was pounding the table to buy silver way before it got to 50. I was telling everybody on my podcast that once we went through 50, we were going to make a quick move up to 100. And my forecast was $100 silver by next year. And we're certainly on track to get there, finishing this year above 70. I mentioned this too on my space, but I'll mention it again because it was really ridiculous. Because I was watching CNBC on that Boxing Day morning, and I'm watching Squawk Box, and Steve Leisman, who's the senior economics reporter, they're pointing out gold and silver, and they're kind of laughing about how much they're up and how much they're up on the year. And then Steve Leisman says, yeah, nobody saw this coming. I can't think of a single person who was pounding the table to buy gold or silver at the beginning of the year. Yeah, he can't think of a single person because None of the guests on CNBC were smart enough to be pounding that table, but I was pounding it as loud as I could.
This is where media revisionism quietly rewrites history. Major financial networks routinely ignore early, unpopular calls, then claim outcomes were unforeseeable. Forecasting $100 silver before a $50 breakout wasn't bold marketing. It was scenario analysis based on decades-long resistance. As Peter Schiff often reminds investors, the biggest gains come from being right and early, not loud and late. For everyday investors, this highlights a real risk. Trusting consensus voices means entering trades after asymmetric upside is gone. And next, Peter Schiff exposes how political narratives misled investors into the wrong asset entirely.
I literally said I'm pounding the table to buy gold and silver, and all year from the end of last year, when a lot of people were bearish because of the election of Donald Trump. People thought that Donald Trump's election was bearish for gold and silver because it was going to be great for the U.S. economy, great for the dollar. It wasn't. The dollar went down. It didn't crash, but it went down. Maybe it's going to crash in 2026. What everybody on CNBC was pounding the table on when the year began was Bitcoin. Ironically enough, right? Yeah, every guest that came on CNBC was saying you got to buy Bitcoin. After all, we got a Bitcoin president, we got a Bitcoin strategic reserve, we got strategy buying Bitcoin. We got all these new Bitcoin treasury companies. We've got all these ETFs. You can't lose, right? You got to buy Bitcoin. Bitcoin was one of the only things that was down on the year. In fact, obviously, Bitcoin hasn't stopped trading yet because it trades until midnight tonight. As I'm looking at it, it's around 87,500.
This part exposes how political optimism often blinds markets to currency reality. The assumption that a pro-growth presidency automatically strengthens the dollar ignored fiscal deficits, rising debt issuance, and global reserve diversification. While Bitcoin dominated headlines, it quietly underperformed traditional hard assets, a reminder that narrative momentum isn't the same as capital preservation. As Peter Schiff has noted, assets tied to liquidity cycles eventually decouple from hype. For investors, the lesson is clear. Chasing consensus trades often means ignoring balance sheets, currency flows, and timing risk. What comes next challenges both bulls and bears heading into the next macro phase.
Buy the breakout in silver. I don't think gold's going back below 4,000. I think maybe 4,200 could be the support in gold. But I think that we're not going to see gold below 4,000 in 2025. I think we're going to see it above 5,000. We may even get to 6,000 because 2026, excuse me, because 2026 is going to be a year of disappointment. Right? Everybody has been optimistic throughout all of 2025. They think the economy is in great shape. It's not. They think that inflation is contained. It's not. It's going to be like the year of Murphy, right? Murphy's Law. Anything that can go wrong will go wrong. Well, I think everything that can go wrong will go wrong in 2026. I think the Bulls and the Bears are going to be disappointed in what happens because we're going to get an economy that is weaker than is expected, but inflation that is stronger. Now, all the people who think that the economy is going to be weak think that that means that there's not going to be inflation. So they're buying bonds, right? The people who think the economy is going to be strong think there may be a little bit higher inflation, but they're buying growth stocks because they expect the economy to be strong. Both camps are going to be wrong. The economy is going to be weak. Inflation is going to be strong. And that is a toxic combination. And the Fed is going to look beyond the inflation numbers. It's going to rationalize them, justify them, explain them away.
The uncomfortable truth here is that markets are pricing certainty where none exists. A weak growth, high inflation environment has historically punished both bonds and high multiple equities. Think late 1970s, not soft landings. The Fed looking through inflation is not a neutral stance. It's a policy gamble with purchasing power. As Peter Schiff has warned, misjudging inflation persistence forces investors into reactive positioning. For portfolios, this environment quietly favors real assets over promises. Next, Peter Schiff shifts to who is already preparing for that reality and who isn't.
Gold, central banks are moving into gold in a big way to get out of US Treasuries. That trend is going to continue in 2026. It is going to accelerate. More central banks are going to get in on the action, meaning that central banks that haven't been buying gold are going to start. Those that have been buying gold are going to buy more. Now, silver has joined the precious metals party. So is platinum. So is palladium. In fact, China recently just announced a ban now on exports of silver. So the supply and demand imbalances are going to continue to move in silver's favor. I think the shorts that are still in this market are still in a lot of trouble. So you have this big precious metals bull market that's now launching into a whole new leg where we're just going to see consistent gains, I think, in gold and silver prices that are going to accelerate as we start to see the US dollar really weaken against its fiat competitors. That's going to put a lot of upward pressure on both consumer prices and long-term interest rates in the United States, which is going to pressure the Fed to do something about it, to try to buy those bonds, to try to artificially suppress those rates, interest rates, mortgage rates that would otherwise be going higher. So it's just going to be a print fest and anticipation of the midterms. So it's going to be a weak dollar. It's going to be strong gold and silver prices. Not really sure about the overall U.S. stock market. I think that it won't be a strong year for tech.
Central banks quietly dumping treasuries for gold isn't a trade, it's a confidence vote. And the dollar is losing. The World Gold Council already showed central banks buying over 1,000 tons annually, a pace unseen in decades. And this paragraph explains why that flow accelerates in 2026. As Peter Schiff often points out, when reserve managers move, they do it early and slowly, not at market tops. China's silver export restrictions tighten supply just as investment demand expands, putting short sellers in a structurally weak position. A weaker dollar raises imported inflation, forcing the Fed into balance sheet expansion even as rates rise, a policy contradiction markets consistently misprice. What Peter Schiff says next reframes which assets actually benefit when monetary credibility breaks.
Just like we're seeing money flow out of dollars and treasuries into gold and now into silver, the central banks aren't buying silver, but I think investors and the public are buying silver. And now this bull market isn't just moving on one leg. In fact, one of the criticisms that it had was that we didn't have the validation from silver. But now we have the validation from silver. And even though gold stocks had a great year, they didn't move up nearly as much as they should have, given the incredible rise in gold and silver. I think that's going to happen next year. I think as good as 2025 was for precious metals mining stocks, I think 2026 will be even better because this is going to be the year of the earnings beats. This is going to be when these companies report these phenomenal blowout earnings, share buybacks, higher dividends, and this is going to grab the attention of the Wall Street analysts, the investing public, especially with a collapse in crypto, because Bitcoin was stealing gold's thunder for the last several years. It got all the headlines, all the attention, a lot of money that might otherwise have gone into gold and silver mining stocks went into Bitcoin ETFs or strategy or stuff like that. But as the bloom comes off that rose, or the tulip, better way to describe it, but as the bloom comes off that crypto tulip, I think a lot of money that got distracted is going to go into the precious metal space.
Silver confirming gold isn't hype. It's the missing confirmation Wall Street demanded before reallocating capital. historically precious metals, bull markets that lack silver participation stall. But once silver outperforms, capital rotation accelerates, something seen clearly in past cycles like 2003 to 2006. Peter Schiff says, mining stocks lagging metal prices signals margin expansion ahead, not weakness, especially with all-in sustaining costs largely fixed while spot prices surge. Analysts chasing crypto headlines ignored valuation math. Miners now trade at compressed multiples despite cash flow inflection heading into 2026 earnings seasons. When speculative capital unwinds from crypto ETFs, it doesn't vanish. It hunts yield, balance sheets, and pricing power. Next, Peter Schiff explains why this rotation could be sudden rather than gradual.
Wall Street is finally going to start embracing gold and silver mining stocks as businesses that have incredible earnings growth, that have incredible value. And that's going to be where money's going to go as it comes out of crypto and crypto related stocks. Now, of course, most money won't come out of crypto related stocks. It's just going to go to money heaven. It's going to disappear as these stocks implode. But the people who get out early will get out with something. And I think whatever they manage to salvage, that money could be invested in gold and silver mining stocks to try to make back what they lost.
When Wall Street finally blesses mining stocks, most retail investors are already late. And that timing matters. Peter Schiff says speculative cycles don't rotate cleanly. Capital destruction usually precedes reallocation, as seen after the dot-com burst when tech losses didn't fully migrate into value. Early exits from crypto-linked equities may preserve capital, but late sellers fund liquidity for institutions stepping aside. Gold and silver miners offer something crypto never did: operating cash flow, dividends, and balance sheet leverage to rising metal prices. For long-term investors, this isn't about chasing losses. It's about shifting from narrative-driven assets into businesses with earnings visibility.